What's all the fuss about credit scores? I'm Meredith Spence, the mortgage lady. Today we're going to talk about credit scores, why they matter, and what you can do about it. Your credit score has many impacts on your mortgage. First, it will be a factor in determining whether you qualify for the mortgage that you will need to buy your first home or your next home. Second, it will affect your interest rate. A lower credit score means a higher interest rate. A higher credit score gets you a lower interest rate. And the lower the interest rate, the lower your monthly payment. Third, if you are making a down payment of less than 20%, then your mortgage will most likely require private mortgage insurance or PMI. Your credit score will affect how much you will pay every month for PMI. You may be asking, what can I do to improve my credit score? If your score is low, this may be because you don't have much credit history. This tends to be the case for young people and also for people who choose not to use much credit. There are steps you can take to build a credit history. Some credit card companies offer secured credit cards. They take a deposit and issue a credit card with a credit limit that is equal to the amount of your deposit. The deposit is returned to you after a year of making on-time payments. For instance, if you make a deposit of $200, then the limit on your credit card will be $200. You'll want to use the card every month and pay at least the minimum amount due so that the account reflects monthly activity and on-time payments. Here's something else you can do. If you have a family member or a friend who is willing to add you to their credit card as an authorized user, this can help build your credit history. Another tactic you can use is to add accounts to your credit report. How does this work? The credit bureaus allow you to add certain kinds of accounts that are in your name to your credit report. For instance, utilities such as electric or gas and cell phone accounts. Your payment history on these accounts is added to your credit report. Did you know that you don't just have one credit score? There are many different credit scoring systems. For instance, car loans, mortgage lenders, and credit card companies don't use the same scoring models, and they assign a different amount of importance to factors such as type of loan or the amount of time you've had the loan. This means that when you look up your credit score on your bank's website or on your credit card statement, the score you will see most likely will be different from the scores a mortgage lender gets when they run your credit report. How do mortgage lenders determine which credit scores to use? Mortgage lenders pull credit reports from 3 credit bureaus: Equifax, TransUnion, and Experian. This type of credit report is called a tri-merge. In most cases, they take the middle score of the 3. If there are 2 borrowers on a mortgage application, then the mortgage scores of both borrowers are compared, and the lower one is used to determine the terms of the loan. You know, it's a good idea to monitor your own credit history to make sure there are no reporting errors or inaccurate negative information that needs to be corrected. You can pull your own credit report at no cost at www.annualcreditreport.com. And the good news is that when you request your own credit report, it does not impact your credit score. So is it a bad thing to have your credit report run by a lender? You know, there's a lot of noise out there about this topic, and it creates unnecessary anxiety. But when you understand more about how the system works, you'll be more in control and able to make smart decisions. When your credit report is run by a mortgage lender, your score will be dinged by a few points. If it is run by another lender within 14 days of the first credit report being pulled, then the second one will not impact your credit score. But this is important. If in the same 14-day period, your credit report is run by a car dealer, a credit card company, and a mortgage lender, this will count as 3 separate hits to your credit score. So here is a good strategy. After your credit report is run by a lender, have them share with you the 3 scores they obtained. You can then provide these to any other lenders you're speaking with. They shouldn't need to run your credit report again to speak with you about mortgage programs or to provide rate quotes. You know, there's a lot of talk out there about not having your credit report run too often, but here's something no one is talking about. Different lenders have different policies with regard to how frequently they will run your credit report once you start working with them. Some mortgage lenders will run your credit report every 60 days. Some will run it every 120 days. And others will run it when they issue a pre-approval letter, and then again when you apply for your mortgage, and then again just before you go to your closing to sign the papers. So can they do this? Yes, they can. Because once you authorize pulling credit, that acts as a blanket authorization for future credit pulls. So it's important to ask what the lender's policy is. Specifically, how often will they repull credit, and at what points in the process will they do this? So what's the skinny on soft credit pulls versus hard credit pulls? Mortgage lenders use a hard pull credit report to qualify borrowers. And as I mentioned, this is also referred to as a tri-merge. A hard pull credit report usually results in a hit on your credit score, lowering it by between 3 and 5 points. On the other hand, a soft pull credit report only accesses one credit bureau, and there's no impact to your credit score. The advantage is clearly that your credit score is not impacted. The disadvantage is that you only get one of the 3 credit scores, and so you might have a surprise, a good one or a bad one, later in the process when your mortgage lender does a hard pull in order to finalize your loan approval. Getting a pre-approval based on only a soft pull credit report presents a risk. When your lender runs the hard pull later in the process, you might discover just before closing that there is something on your credit report that needs to be addressed. And that is why we recommend you have a hard pull credit report done sooner rather than later. If you have any questions or would like more information, please feel free to text or call me at 781-910-9988. I'm Meredith Spence, the Mortgage Lady.